Hi, I'm your host, Sophocles Sophocleus. On this podcast, we discuss interesting stock ideas from around the world. The goal is to have meaningful discussions by getting into the numbers and better understanding the opportunity. Thank you for joining us. This podcast is being made available for educational purposes only. It should not be used for any other purpose. Full disclaimer at the end of the podcast. So today I have with me Julio Utrera. Julio is a CFA charter holder. He is a senior analyst at Southeastern Asset Management. He previously held positions at T. Rowe Price, JP Morgan. He has the privilege, I'd say, to be working in a very concentrated fund for Southeastern that holds only about a dozen positions. And he will be talking to us today about one of those. So, Julio, welcome. Thank you for doing this. I very much look forward to our conversation.
Thank you very much, Sophocles. Glad to be here. Thanks for inviting me.
So, Julio, what's the company? What does it do?
So the companies, and I know you put a disclaimer at the beginning, as you said, and at the end of the session, but just for the avoidance of doubt, this is no investment recommendation by any means. It's just for people to be encouraged to start doing work on the company. And I know there's many smart investors following you. So by all means, anyone that looks into this and wants to give me especially the bear arguments after watching this, I'll be more than happy. Please keep all those questions coming. So that's it, that up front and out of the way. The company is Allfunds. It's a 3.3 billion market infrastructure European listed company. As I said, 3.3 billion market cap. It trades around 10 million a day, slightly less liquid than that, I think, for people looking into it. And the elevator pitch is, it's a high quality market infrastructure asset that is going to grow double digit over the midterm. That is now priced at close to 10% free cash flow yield on next year's numbers because of misperceptions in the business model. So one of them being, there's two fronts to these misperceptions, which we can go into, of course, in detail. One of them being the lack of understanding as to the quality of the business fundamentals. And that means it's much more associated with, beta-driven, sort of market-driven fundamentals from the business, as opposed to the actual, subscription business and the actual lack of correlation that it has to markets. When we can go into that into as much detail as you want. But then the second one is this has become a special situations play. By and large, the shareholder situation is such that this was a private equity-owned asset, IPO in 2021. Private equity still has 40% of the business, Hellman and Friedman does. And hence there is a private equity overhang that drives the shares. And this has been very clear for the last year and a half. That essentially is the news flow around the potential take private or otherwise, selling of that stake. That's really driving the share price. And that has been keeping them down versus fundamental a fundamental story that has been picking up and gathering momentum.
You know the company and what it does in detail. Now, what exactly is their business? How do they make money?
Absolutely. So Allfunds, what it does, it's a fund distribution business, and what that means is, I would say it's the I'm going to say it's the Amazon of fund distribution. And the reason why I say this, I know there was a time when you had to start an investment thesis with, this is the Amazon of, or the Uber of its industry, right? Otherwise it wasn't worth listening to. So I know it's been used in the past quite liberally, but the reason why I say this now is because, the Juan, the CEO and founder of the business, so he's a founder-operated business, which is part of the attractiveness as well. He actually defines it as the Amazon of fund distribution. And at inception, that was his idea. So what the business does is it scratched the itch of a asset manager professional 24 years ago now, which was Juan Alcaraz, working in Santander Asset Management and servicing, for the most part, private banking clients, but also mutual funds and so fund distribution, fund of fund type of clients and other institutional clients, where he had to service asset base of distributors that had to have independent agreements, much like the pre-Amazon world, right? Much like you would have on the retail street, where as a distributor, so as a customer, you would need to have single agreements with every single merchant if you wanted to purchase something. You did not have the concept of going to a marketplace proposition where you had all of the breadth of the offering that you could have in Amazon, for instance, as an online platform. So that's what he did. Like him as a, you can think as a fund distributor. So someone that is dealing with, let's take private banking for to make it simple. So a private banker that has a myriad of customers, and you want to offer them products that are outside of your Santander Bank proprietary products, right? You want the Schroders fund, you want the Southeastern Asset Management value fund, you want the whatever fund. You as a Santander Private Bank would need to have all of those agreements in place for you to be able to have that offering to the client. And that's a hassle, right? That has cost implications from a back office perspective, that has know your client implications from a regulatory perspective, that has all of those implications to have all those distribution agreements in place. What he incepted at the time was, let's make these a platform that at the beginning can service us internally, but then was opened externally to others as well. Where we all do all of that, we centralized all of that fund distribution. So all those fund agreements are centralized in these assets that we call Allfunds, and then people can plug into it. And the beauty of it is, much like Amazon, is what they call the buy free model. So from a distributor perspective, so a Santander private bank, a Intesa San Paolo private bank, they can log in the platform for free. So they're not paying anything to have that breadth and offering, much like you're not paying anything to open an Amazon customer account as a customer. And then you can plug in into all of that optionality. The ones paying for the ones monetizing the business model are the funds that are part of that community, much like the merchants in Amazon. They're the ones paying Amazon and funding the operations. And the way that works is that from the fund side, they get access to these massive additional distribution capabilities that Allfunds has, right? Because you can go to where your potential clients are, and you will pay. There's a nuance to this, but for the most part, you are paying on the assets under management that are contracted through the platform. So you are paying, again, there's nuance to this, but for the most part, you are paying for whatever is contracted in the platform for you. Much like a merchant, when they sell through Amazon, that's when they're paying fees, right, to Amazon.
Okay, so the wealth manager, let's say the private banker, he
Mm-hmm.
logs in for free, costs him nothing,
Mm-hmm.
and
Private model, exactly.
basically the funds pay
Yes,
for whatever's allocated. So it's not based on like their entire fund size. It's based only on what's allocated. I mean, from what I understand, that's like a few basis points. Is that right?
correct. That's exactly right. That's exactly. There is, as I said, some nuance to this. So for people looking into this, by all means, don't take me literally on this, but because there is some subscription one-off and things like that for the funds. But as you model the business model, and for the most part, this is a basis points under times assets under management, um, or administration rather, assets under administration model, and that's the core of the business. Um,
That's so
and
confusing. I was looking at that. I was like, why don't they just call it AUM?
well, it's because of and then you have the assets under custody as well for other competitors. So there is a nuance to
Oh,
custody
I
is
see.
much less value added than assets under administration, and indeed they don't do the management of the assets. No, they're just doing the administration of it. So it's like different. It's legal terms for the different types of plumbing that you can do in this industry, essentially. Um, so for to your question as to the pricing, it moves around. For the smaller asset managers, they need to pay up to 10 basis points. For the larger ones, it comes down to three to five. And so the model as it is today, and when you look at consensus and all the numbers and what the market is focused on, we're looking at that range of between 3 to 4 basis points that they're obtaining on their assets under administration.
So,
Mhm.
I see on the website they also have these other things like say like blockchain solutions, ESG solutions,
Right.
but I didn't see anything like, are they making any money out of this, or is basically fund distribution 99% and then everything else is like not worth
it's
mentioning?
it's 90 to, depends on how you account for, like how you define it. It's 90 to 80%. That's platform fees, what you call platform fees. So the AUA times basis points revenue model. The rest of it is what they call the subscription revenue model, and that is the next leg of growth, if you want to think it that way. That's what they're pushing now. They did an acquisition last year, 2 years ago, mind you, that was pushing this Web Financial Group. And indeed, if you talk to Juan, that's what he's really excited about as part of the offering, right? So if this becomes a multi-bagger, that's kind of the development that it follows. As I mentioned, this is around 12. So last quarter, this was 11% contribution. For the year, it's going to be thereabouts as well, the subscription revenues. At some point, they released a soft guidance for which they've now not backtracked, but they haven't alluded to it much again, that they would like to see a 30% revenue contribution coming from subscription revenues. So sizable. But that's a loosely defined midterm in the next 3 to 5 years. So it will take a while. And that will need additional M&A on top. So it's not an organic, purely organic play, if that comes to
Okay.
pass.
Okay, yeah, I think I see this. So they break down their revenues into platform revenue, asset based, platform revenue, transaction based, and
Hmm.
subscription and other revenues. So all this other
That's right.
stuff is basically in the subscription and other revenues. Okay.
Exactly. Exactly.
And
And a lot of it is,
whereas,
I mean,
yeah,
the
okay.
beauty of this is that, you talk to management as well, is that it's wonderful, right? Because you have this Amazon platform, as we were discussing, where you have all of these relationships. And then the distributors are telling you, as well as the funds, like what their data needs are, right? So for a lot of the distributors, like the private banks, it's about MiFID regulatory stuff that they need to report, and about regulatory requirements and all of that. So they get to build either internally or they have acquired externally whatever it is that the clients are demanding, essentially. For the funds, it's been, that ESG was, a bit less so in vogue now, but they had a day under the sun for a couple of years. There's a genuine demand now for, well, that ESG data and analytics as to how do you define that and how do you implement that in fund reporting and how do you implement that. And so all of those, the acquired one asset, which was precisely that, and they're able to integrate that and have that offering. Which is not only
Mhm.
helpful for, as I mentioned, like regulatory reporting purposes, but also for filtering purposes, right? When you're on either side of either the fund side, fund houses side, or the distributor side, you want to know and connect quickly to whoever it is that's interested in your potential product if you're an ESG specialist. So you can think of it as that sort of subscription information analytics type of revenue streams that they have now in place.
So I'm going to give you, Julio, a couple of pushbacks because
Mm-hmm.
this is going through my head, and I'm sure you've already thought of answers to this, so it will help also people listening.
Of
You
course.
know, one, you said wealth managers can log in for free.
Mm-hmm.
Well, I can tell you, a lot of wealth managers and private bankers, free is not good enough.
Mm-hmm.
They what I'm where I'm going with this. It's like they'll be like, well, what's in it for us? Now I understand regulation is somewhat changing that.
Mm-hmm.
But I'd just like to hear what you think.
It's true. It's a great point. I mean, it goes to what one of the key competitive advantages of this business is, right? Which is scale. Like this is a 1.5 trillion as of yesterday that they reported assets under administration business. So what that means is there's a lot of people on this platform. There's like 1,400 distributors. There's I think it's like close to 4,000, 7,000 fund houses now. I would need to check on that number again. Um, so you have an ecosystem already, which you just can't replicate. If I gave you, $4 billion now to go and replicate exactly what Allfunds, you can't buy that from day one. And so what you have is not only a freebie for a fan house that goes into a technology platform that is unproven, potentially unregulated, and has no funds that you would be interested in So why would you log in, even if it's for free, to an actual ecosystem that they've built over 20 plus years? So
Yeah,
that's.
but if the private bank can get like some fees, not only free, but they don't like, they'll be like, why don't, for me to allocate to whatever fund, which is outside, let's say the bank or
Mhm.
outside the manager or whatever, free is not, is for them. It's how much are we going to make, not as in the client, but the
Yeah,
bank themselves. I mean, they'll make, you know, we want 10% of,
yeah, yeah.
or whatever, or,
No, I hear you. I hear
an
you. Yeah.
incentive fee. I mean, can that be structured?
So yes, two points to that. There is, so one is, what you're getting is indirectly all of that department that you needed to have for agreements to different fund houses, back office, KYC functionalities, having all of that in place, you can eliminate, right? So all of that you have outsourced into Allfunds. So that cost savings, that's what you can allocate to your P&L day one by externalizing, outsourcing this effectively. And then more directly, yes, there is this, and this was a big debate actually for the bears on the stock on 2022. Rebates are a thing. Depends on the geographies. For Asia, it's now a larger thing. For Europe, decreasingly so. And rebates was a function of that. So there was an element of rebating in the platform going on. This has gone down because European regulation, and this is for the most part a European-based business. European regulations are, as per MiFID II, like the best execution type of regulation
Mm.
that's coming
Hmm.
through. Rebates are more and more looked into and looked, frowned upon. So there's definitely an element of that going down. And indeed, in the platform, that's less than, I think it's aimed to be almost 0% revenue contribution by next year. I think at present it should be, from memory from last reported, it's like definitely less than 10%. I'm gonna say.
Hmm.
So it's coming down, but yes, there's definitely that element of rebates agreements happening between some of the fund houses and which all fund is of course evolving.
And there's probably some people, even
Mm-hmm.
though it's probably illegal, there's probably some places that they're finding ways to go around it, or maybe they're
Mm-hmm.
finding some sort of loophole where they get some other type of benefit. Maybe it's not monetary and so obvious, but maybe they get some other type of benefit. I don't know. Maybe, you're a small wealth manager in Spain, let's say, that you're so small, you're under the radar of anyone, and then you go and you make an agreement directly, let's say with UBS, and I don't know, maybe UBS gives you access to their research or something,
Right,
I don't know.
right.
Maybe there's some sort of loophole. So that's one big concern of mine. Of course,
Mm-hmm.
like you said, as the more years go by and the regulations in place, that's, I guess, less of a threat. But then
Mm-hmm.
there's this other thing which I was thinking about at one point. I was thinking about yesterday. I was like, wow, this is great. 1.5 trillion
Trillion. Yeah.
um, assets under administration. Well, it must be like a zillion funds there for me to look
Mm-hmm.
up. The problem is that there's two issues with that. One is the average wealth manager probably doesn't need so many options, you know.
Mm-hmm.
Unless you're a wealth manager or whatever, private banker, all you need is like, I don't know, one global equities fund or one value fund or one small cap fund. And do you really need to like show your client like, 200 different choices? And that's one issue in of itself, that they probably don't even want to have that many choices. So if you have 1.5 trillion or like zero point 0.5 trillion, or, whatever you have, I don't know, whatever, 100 billion, it doesn't matter. And then two, there's this, the big headwind probably for this is like ETFs. So if I'm like a wealth manager, and I have like a high net worth individual, and he's like, I want exposure to equities, I'm thinking, yeah, I can log into Allfunds and look at, whatever the best performance are, blah blah blah, give him a
Mm-hmm.
choice.
Yeah.
But then if he loses money, I could, he could blame me. I can just either one, show him, oh, here's UBS, JP Morgan. Just show them someone big, right?
Mhm.
Whereas I could never get the blame, or I could just put them in a MSCI World, S&P 500
Mhm.
ETF, or one of these zillion ETFs, low cost ETFs, and then I don't need to have an agreement with Allfunds. I don't need
Mhm.
to go to all the hassle. What do you what does what do you think about that, or what Allfunds thinks about that, or
Yeah, I think. Look, if you like the idea so on the first point, right, on the offering, like the breadth of offering, is that like overkill? Is that necessary? Um, I'm I think clients do appreciate having that breadth of, well, like, look, these were the best performing funds, and it's not me showing you again, just for the sake of example, Banco Santander, nothing against them, but for the sake of example, Banco Santander showing you the best performing Banco Santander global equities fund that we had from last year, but rather, here's the Julius Baer, here's the Schroders value, here's the, T. Rowe. So I I think there's an element of sophistication to private banking institutional clients, which is what this is catered to. That is, they appreciate the diversification and they appreciate the breadth of offering. And for that to be like a truly representative example of what's the best offering that's potentially out there for me, as opposed to what's the most beneficial for you, what are your best two captive funds that you're showing me, right? Making the most of my fees, essentially, because I'm banking with you, private bank X, not say any names. So I think there's an appreciation from a sophisticated client level. Equally, there is definitely an appreciation from my regulatory, right? If the regulator asks level, which is what's increasingly happening on the, as we mentioned, the best execution type of practices. So if the regulator goes and asks you, well, how are you treating your clients? And you say, I am plugged in for free, buy free model. Let's not forget that. So it's for free. I'm plugged in into this platform where the clients clearly can see the breadth of offering that we could potentially get them through the Allfunds platform. You're pretty well covered because you've got that breadth of, there was no, by any means, anyone could log in and look at all that breadth of offering, versus the other scenario, right? Which is why this whole theme, for people looking into this in more depth, this, or which, like the whole open architecture, what's called going from captive to open architecture industry trends, it's so big. Like the clients moving, it's not only like the GDP plus growth of the asset management industry, like there's also that underpinning of structural growth story of people moving into open architecture. Um, so that's one as to the breadth of offering, and then remind me what point were you making on the on the big guys showing.
oh
Um,
yeah, so no, I think you just basically
mhm,
you countered the argument, because I was thinking,
right.
you don't have to show them that many,
Hmm.
and maybe you countered that because if the regulator comes,
Hmm.
then you can never be criticized that you didn't show them enough.
Hmm. Hmm.
So you're pretty much covered by that. The other one, the part two question is like, you know, maybe someone puts them, a wealth manager, just to save his own butt, is
Hmm.
puts them into a UBS, a JP Morgan, or maybe
Hmm.
just puts them into ETFs.
Right. Yeah, that was the second part. Thank you. Yeah,
And probably
absolutely.
ETFs is the big risk here.
Yeah. Well, it is. And that's why, as of last quarter, they announced they are going to do. So, right now, we're focused on public securities, broadly speaking. That includes ETFs, by the way, as of today. So you can have, and actually they have good disclosure on this every, not for the quarterlies, but for second half, for half years and for end year reports. You have that disclosure as to products. Equities are currently just over 40% of the assets under administration. So you do have fixed income, money markets, multi assets that make up the whole book, the whole part of the the assets they administrate. And indeed, that's been an issue for the business. One of the bear points has been clients have moved with a higher interest rate environment. They have moved a lot towards money markets at first, and now more into fixed income, less so into equities, which has hit margins. So now that should be a tailwind as we exit the lower rates environment. So that's a plus now. But it has been a tough environment for the business over the last 2 years, precisely because of that, right? Because clients moved to these higher yielding, lower fee generating asset classes. But those asset classes are already in place. And that's the good thing. Like, one of the benefits of Allfunds from an Allfunds business perspective is that you have that breadth of, you have the funds, equities funds, but you also have multi-strategy plus fixed income money markets products even. And you stay within the Allfunds ecosystem. You're not taking it out to your private bank money market fund necessarily. What they've done now is they've gone further and said, okay, what are clients, like our distributors' clients, asking for? Private assets, right? As you know, private equity has been, private credit and across private asset classes have been outgrowing the industry substantially. So they started a alternative assets platform within Allfunds as of end of last year. They already have 16 billion assets under administration there. So it's small but growing. With a panel of, you can think of the top 20 private equity houses, the KKRs, Morgan Stanley Infrastructure, and a couple of others that are already offering their products through their private asset products through Allfunds. And then starting as of next year, as of first quarter next year, they will have their ETP, exchange traded products platform, also live within Allfunds. So this thematic ETFs and those all stuff, which is also, again, it's grown from almost nothing to a 100+ billion industry. That will also be part of the offering that you can contract through the Allfunds platform. So you keep it all into one-stop shop. That's, of course, their vision, right? That you can have it all, not only public or listed assets, but rather even private and, derivatives, if you want to call it that way, all of it through the Allfunds platform. That's what they're aiming to have.
Have you seen the platform?
So you need to be an institution. So you can't do it through a normal login as it was an individual. But I did, in their offices, I did take a look at their screens, like behind the shoulder of the guy. It's pretty neat. It's pretty. I mean, you can see pictures if you Google it, like, of the platform. It looks very much like a, AGVL or Parkinson, like a sophisticated, well put, consumer friendly platform.
Considering all the amount of funds, it would be really cool if someone could do combinations and then see what the return would have looked like historically.
Okay.
I don't know. I'm just curious. I probably spend hours doing that.
Yeah.
It was, if I had access to that. But
it's a fair point. Like, that's the thing, right? It's like the data richness of it and having all of that, and especially in an increasingly AI world, like that has massive value, right? That has massive value, which again, we're just discussing these AUA times basis points, like basic business model of it. But as we go further, and this is indeed the multi-bagger thesis for this, right? Which I'm not advocating for today. But if this goes really, really well, that's essentially it, right? It's monetizing more of the subscription part of the business, growing that significantly, and just making the most of this data lake that is proprietary to them.
Well, I do know a fund of funds, actually, that has like 6 servers running data on like thousands and thousands of hedge funds whose data is fed into their own in-house built system. And that's how they select the funds that go into their fund of funds. And, it's and it sort of was worked for them. But, it's powered by this, like I said, the 6 servers, and then their own overlay of qualitative research. So having seen that and knowing all the data these guys have, they could definitely maybe charge a fee for some extra service, because, just doing this, funds paying just for this access is probably going to go down over time, just because fees have been suppressed so much that it can only there's only one direction all of these fees have been going. And so how do you think about that? The basis points they're earning, have they talked about, because I think they'll be earning less from the funds over, in the future, that they'll be growing their assets under administration, but their fees they'll be receiving will be in basis points will be lower. So
Mm.
they're sort of forced into having additional services in a way in order to survive. Maybe that's what the market is thinking about and worried about.
That's definitely one of the bear arguments. I don't think that we necessarily agree with the fact that their pricing today is unsustainable at these levels. Um, just simply looking at the numbers, right? Like, yes, there's definitely fee compression, and yes, you definitely want to pass on that to your middlemen, you know, as an end user, as an end fund house. But it really comes down to, how much value adding is this middleman to me relative to, what's my return on investment relative to what I'm paying to this supplier, right? And for the purposes of Allfunds, we see it as a, very appropriately priced. So the 5 basis points on average, again, this depends, this can go up as high as 10 depending on the fund house, but for the more scaled houses, it's 5 basis points or less. Given all the access that you're getting, all the distribution capability you're getting, increasingly, as you already alluded to, like the subscription, so the fees that you're paying, but the subscription, data analytics on the side, ancillary services that you're being cross-sold, and which is working quite nicely for a lot of these fund houses to have, because they can do like further distribution, right? Like more targeted distribution through the platform and find new clients, etc. As an example, 5 basis points is quite reasonable. And if you think about it, like even the lowest priced, like S&P tracker that would charge you what, like 12 basis points, 15 basis points, like relative to, you put that in context, those 5 basis points, of course, in that example, that's a material, right? Like one third of it. But even in that example, kind of like if you're getting enough distribution value added capabilities, it could even work for a
But
50 to 100 basis points. Mhm.
I was looking at their in their historical assets under administration and
Mm.
their net fees, and it seems like it's come down over the last few years. It's come down to about between 3 and 4, it seems, whereas it used to be 5 plus.
Mhm.
I'm
Yeah, like as
wondering
in,
also.
I take the point as in, will this be going down to two essentially? Like that's the bear case. Like, is this a steady trend
Yeah.
down? And our point is, and you've seen that for the last 6 quarters, so more than this year, where it's actually been trending, a stable to up at this level. So it genuinely
Okay.
feels like it's troughed at these levels. And when you go through the numbers and you see the market dynamics, I mean, for sake of example, the exchange traded platform products that I mentioned will be started in Q1.
Mhm.
That will be margin accretive. So on exchange traded platform products, which again are like lower basis points, are like they're lower, low price products, that will be margin accretive to the platform. That will add relative to the 3.8 basis points that pricing that they're getting currently. So I think that just tells you, right, that they are at a price level now, given their scale, where anything is pretty much incremental. Definitely on the listed part, which is the lower margin part. But then, as we mentioned, they're rapidly growing their private assets part of the business. Today is very small. It's like 1% of the AUA, like 16 billion. But it is picking up quite nicely, and that's an order of magnitude higher. Huh? Like that's almost 2 to 3 times, depending on the product, on the private equity fund or the private credit fund. And that's 2 to 3 times the margin that they get on the comparable listed equity. So they're looking into it. Like that's one of the benefits of having good management in place. As in they're definitely cognizant of these things. They see the market dynamics and they're acting accordingly.
So do they also do custody
Yes,
or
yes, that's part of the offering.
okay?
Mm-hmm.
So now they have a lot of funds, they have a lot of offerings and
Mm-hmm.
services, but there's also other platforms. I saw in their prospectus from a couple of years ago, they had this couple of charts mentioning a bunch of different competitors.
Mm-hmm.
How well do they compete? Because let's say they have 1.5 trillion, whatever,
Mm-hmm.
right? But if I'm a wealth manager, private bank, and I get the competitor, which is 1 trillion,
Hmm.
it's the same thing,
Mm.
essentially. So how do they compare? Is there some differentiating factor, do you think, for these guys versus their competitors, or are they basically commodity product?
They would, they argue, and I think we partly believe the case that they are more differentiated, as in they manage to be a lot more tailored than some competitors can get to be. They have a more extended, as we were alluding to, the subscription part. It's a more extended value proposition that they get to are able to get to clients as opposed to custody plus. So there's two big competitors for Allfunds in Europe specifically. One is Clearstream, private business, and then Euroclear. Sorry, the other way around. Euroclear, which is the Deutsche Börse owned business because they bought it from UBS 2 years ago, and then there's Clearstream, which is privately owned by many different banks. So those are the two large competitors that they have. If you talk to Allfunds, or indeed to any of them, you will know that Allfunds is the big gorilla. So it's like the big out of the three, and they've never lost a mandate that was purely on client services or capabilities. Like they haven't lost many mandates over their lifetime, but whenever they lose it, it's purely because their offering is too wide and people are just looking for custody, like simple custody. Whenever someone wants something that is slightly more enhanced as a distributor, they go to all funds. So that's kind of the value and the offering that they have. They're a bit of the premium option, if you will.
They also have fund distribution then?
They'd also have fund distribution. If you look at, the only because Euroclear is private, but Clearstream, as part of the Deutsche Börse reporting, they disclose it separately, which is super helpful, as the fund distribution business. It's the smaller segment that they have, and that's kind of a peer, very close peer that you can have, and also we get that information quarterly, which is helpful, because you see. I mean, when you see Allfunds in isolation growing double digits, and you wonder, is this actually sustainable or not? It's helpful to have Deutsche Börse disclosing that they're expecting an 11% CAGR over the next 3 years, and they grew 15% year on year this last quarter, and so yes, we keep an eye on that as well as a peer. It just tells us, it just validates the fact that the market is growing, the open architecture market is growing for us, which is helpful to know.
But you believe they have a little bit some type of differentiated offering or
Mm-hmm.
service
You can think
to
of them as
end clients.
the freemium and more tailored type of proposition. The other one is more plain custody plus,
Mm.
and they're trying to replicate a lot of the things that Allfunds comes up with. So if you look at the industry dynamics for a couple of years, it would be Allfunds coming up with, be it organically or through acquisition, like some offerings for clients that then these guys go and replicate afterwards to an extent. So they're leading the pack.
Mm. And is this why they have an increasing employee cost? Like, are they trying to offer better service somehow? And I don't know how their competitors are doing, but you can see
Mhm.
that employee benefits are on the rise. So I was looking at this and I was wondering, isn't this like mostly a tech platform? Shouldn't there be more leverage?
Yeah, no, that's fair, and thank you for flagging that. I hadn't appreciated as much. There's been definitely a phase of investment, as I mentioned. They started the private assets platform 2 years ago. So it started 2 years ago, and then they launched 1 year ago, right? Now, currently with the ETPs as well, they just did like two big key hires essentially to launch this business, which they announced first half. So there's definitely been, I think, to your point, there's been a couple of key hiring, investing in the business to accelerate this to prepare the base for this next phase of growth. I think it's probably comes linked to that. I mean, the business itself is super scalable, right? It's like a 70% or 65% margin business, and the midterm guidance for it to increase to 70%. So it's just very, very, very scalable, and it is the beauties of a tech platform that it's just market infrastructure that's currently built. Any
Mhm.
assets under administration that you add in there, they're effectively dropping to the bottom line. So
What?
so yes, the scalability factor is there, but there's been an investment in the
Yeah.
business. Yeah.
I don't know if you studied the acquisitions they've done, and do they make sense? I mean, are they paying the right price?
Hmm.
They
Yeah.
spent like
Oh,
260
absolutely. Look,
million in the last two
I
years.
think to your point, I think early is, we are, so full disclosure, as you know, we're invested in it, and it's just about the right time, because this used to be, so this was private equity owned until 21, as discussed, which is when it did the IPO, and then still today it's partly owned, like a large stake is partly 100% owned by private equity. So this was naturally a consolidation play within the industry, right? Using the platform and hoovering up a lot of assets. So yes, there was a lot of integration of different capabilities and putting it all together. What you're getting now is as I mentioned, the big gorilla in the industry that has that breadth, that competitive advantage, and that has put the two additional engines of growth in place by now. So this is definitely an inflection point where they don't need, and if you talk to management, they will confirm this, as in we're still on the lookout for good M&A opportunities on the subscription side, of the business, subscription revenues, but we have all the capabilities that we need, as in we don't feel like we lack anything that clients are asking us for that we're not able to provide, which is a great position to be in. We looked at the acquisitions. Yes, they are phenomenal, right? Like the economics are such that, as we mentioned, it's a 60+% EBITDA margin business. If you do a platform business, so you're buying one of the smaller, in Spain, it was just Inversis, which was just acquired by a small competitor, Bancamart, this year. I mean, those type of transactions that they've done a lot of over the last couple of years through their private equity ownership, they're massively accretive, right? Because you've got the platform, you've got all the tech in place. You're just adding AUA on top of that, which is very easy to integrate for the most part. And so that just drops to the bottom line. The CFO was telling us that, those are 85% plus EBITDA margin acquisitions on year one. So that's phenomenal to do. The subscription
But
revenue side. Sorry.
like in 23, they pay. I see on the cash flow statement here they have like
Yeah.
140 million of cash acquisitions.
Yeah.
Let's just take that one for example. I don't know if that
Mhm.
was one or two, three
I
companies.
think that's mostly Icrea, no? Banca Icrea in Italy that they closed last year. So it's probably that one that you're referring to.
What multiple do they pay for that?
I would need to think of it, but I mean, it definitely doesn't. I'm blanking now. What's it, double
Or
digits
was it
something?
not
No, but
disclosed?
I'm not sure that it was. I mean, we definitely discussed this, but yeah, I would think double digit EBITDA multiple type of. But I would need to go back to you on this one. But the point being though, like the price, it's definitely not. We're value investors, so we don't like high multiples, high positions. But the fact that like it's so accretive, right? The synergies are so massive because you're just plugging in like any incremental assets under management. It just drops directly to the bottom line with virtually zero. There's very little integration risk, right? If you've done the due diligence on it. So their acquisitions are a very good deal. Essentially, that's ultimately what we're getting. Like in fact, like one of the points was, they've consolidated to an extent on the platform business that they're now less keen. I mean, if the price is extremely attractive, they will look at it. But now they're less incented to keep adding on the platform business because what they want to do is they want to move the narrative away from where a platform markets AUA driven story. We're now growing on the subscription revenues, non-market correlated revenue streams. So that's the one that they have been more focused on, which has more inherent M&A risk to it. But strategically it can make more sense, and it can attract higher multiples if you go for the Weasley wealth tech expensive stuff. So that's why, again, because they're very good capital allocators, that's why they've been really cautious, and you haven't seen that much activity that they've acquired there.
Is this just the fund distribution? Is there some sort of bank in this? What does the balance sheet look like? This 2 trillion whatever cash, is that real
Yeah,
cash or Is that owed or something?
That's part of the beauty of it, right? It's part of the complexity as well. So it's if you look at it in Bloomberg, you'll be it's like you get funny numbers essentially to put it in
Of
short. In
course.
fact, it is a little bit better because it actually the entity is a bank, so it's a regulated bank in Spain that traded
That's
in
what
the
I
Netherlands.
thought.
Yeah, so it looks funny that way. If you look at the reported numbers as per the company, that's what makes more sense. Like it's more sensical. In
Okay.
terms of leverage, because you do have float from clients, so that 2 billion plus, what they have is actually float, which is clients, putting in, the distributors putting in the orders from the clients, as in we're going to acquire these, ETF or this equities fund or whatever. It will be in the platform sometimes for 1 day, sometimes for 2 days until they do the closing, and they get an interest income revenue free from that all
Okay, so
month.
if I
Yeah.
have if my client is going to buy a fund on the fund
Hmm.
distribution platform, I send the
Yeah.
money to all funds and all
Exactly.
funds takes care of the rest. And that's why we see this big cash and cash equivalents. This is why we see financial liabilities as
Indeed.
well, which is shown because I looked at this and I'm like, this doesn't look like a tech balance
Exactly.
sheet.
Exactly. It looks like a bank
Um,
balance sheet. Precisely.
it
Yeah.
looks like
And,
it looks like a
and
bank
then if you
balance
look
sheet.
at the leverage, then you need to adjust. So what they're currently at just below 1 times 0.8 times leverage. And that's essentially when they're disclosing on their capital requirements, that excess capital number. That's what you have as the that headroom that they have. That's
So
what you can
what's the
say.
actual net debt here? Just so I understand.
The actual net debt is about more closer to 300 million. Sorry, yeah. So that's closer to 300 million, which
Closer
is
to
again, if you
300
look at,
million?
yes, which is just below the 1 time EBITDA exactly for the last 12 months. And
Okay.
that's the net debt that they have, which makes it a very solid balance sheet. Of course, is one of the attractiveness of this business.
Okay, so there's
Um,
like 300 million net debt and then there's
yes,
another roughly 3.3 million roughly market cap, right? Which
yes,
would take us then to 3.6 enterprise value.
hmm correct.
And on EBITDA, I think what are you
It's
seeing
just below nine
EBITDA?
times.
So it's about 400 million
Hmm.
EBITDA. Hmm.
Yeah, so just below 9 times, just about 9 times. If you want to make it round numbers, yeah. Which is the beauty of it, right? Like that's where the whole debate is. Like it's trading at 9 times, EBITDA. It's around 9 times or 9% or 8% next year's free cash flow yield, which is not a multiple that you get for a high quality market infrastructure asset, right? Like these, like the Deutsche Börses, the London Stock Exchange, like that type of market infrastructure, they're trading at 50 mid-teens EBITDAs multiples. And that's where the debate is right now. This gets on the bucket of, as we were discussing on the not so short elevator pitch. There's some cyclicality that gets this is being seen as a cyclical asset. That's what the market is inferring by that multiple. I said this is a lower quality or very market driven asset, which is not the case if you look at the P&L over the last couple of years, especially in 22. And then there is the special situations angle as well, which we can get into as well, which makes it trade not according to fundamentals.
So wait, what's your estimate for free cash flow then?
We don't share in open forums, but I mean, consensus is first half of the year for already was 120 million, just over 120 million free cash flow that they generated. I think you can double that essentially this year, so 240 is a very fair number that the company can make guiding
So
forward.
240 on 3.6.
Yes, free cash flow yield, exactly. And that
Is
keeps
that
growing at double digit, right? So if that's the case, you look at a 300 million free cash flow generation asset over 2026, 2027 easily. That's capex inclusive. That's around 50 million of capex that they spend every year, and it's more than enough to do maintenance capex as well as keep upgrading the platform.
okay? So you said they make about 120, but if I look at the interim, I guess this is part of the complexity of it. It looks
Mm-hmm.
it looks more like they made 500 from operating and then 80 from investing.
Hmm.
Is the 120 basically what um, Is
That's
that
reported.
just
That's in their presentation, the 120 million free cash flow in the
okay?
first half presentation. And the thing
And
is, in the reporting, I mean, there's two things with the reporting, right? Like one is
it's
very
the financial
bank-like.
liabilities.
Yes, it's like very
Yeah.
bank-like type of reporting. So the cash flow statement doesn't make that much sense. That's how it's reported in terms of the underlying business. And then secondly, up until last year, this was a very highly, as we discussed, acquisitive business under the private equity period. So there's a lot of, you know, EBITDA adjusted and one-offs, transaction or service agreements, and one-off stuff that needs to be cleaned out essentially from the financials. So, I mean, by no means that the adjusted EBITDA is not like community adjusted WeWork type of adjusted EBITDA. Like it makes a lot of sense as to what they were adjusting. But the point is that it didn't make the numbers that easy in the past. It's one of the beauties of 2024. It will be the first year that's actually pretty clean financials, and adjusted numbers will be not substantially different, some minor things, but it will not be substantially different to reported EBITDA
Why is
numbers.
that?
Well, because there were some transactional service agreements. One big acquisition that they did, for people that look into it, was the BNP custody business in 2021. So there was a lot of, and you will see a lot of goodwill in the balance sheet as well, coming from that acquisition, as well as others. And then there's a large, very large, PPA, the purchase acquisition depreciation that goes into the numbers as well, because of that acquisition again, but some others prior to that. So there's these complexities into the accounting that makes it you just need to spend a little bit of time, but it's not helpful, right? Even when you spend the time to see those one-offs, because analysts, they don't like to see that. And as of 2024, a lot of those one-offs, they stop showing up, and that's helpful just for the story and the narrative, which makes it cleaner.
Okay, so the story will be a little cleaner next year. What about this
Mm-hmm.
in something I didn't understand in the other expenses? What's the subcontracted administrative services? I saw they had like a big 40 million benefit from
Mm-hmm.
that coming down.
Mm-hmm.
I thought I'd ask you, see if you.
I think that makes reference, like the subcontract. I think that makes reference to the transactional service agreements. So they have these expenses that they need to, which is what they adjust effectively, because they will stop paying those out for them for
Okay.
the first couple of years to BNP as part of the transaction.
So, okay, what do you think this thing is worth then?
We don't share internal valuations in open forums, but that's it. Consensus is currently at €8 per share. So as of today, it's at 5.5. For people watching this, 24th of October. Importantly, it's not just that consensus today is at €8 per share. It's not that the higher end of consensus can put it at €10 per share. It's the fact that in February 2023, you had an offer on the table from Euronext for this business at €8.75, which should give anyone catching up with the story a lot of confidence that a private, informed party that was willing to acquire and integrate this was willing to pay €8.75. So that didn't go through in February 23, and then the share price did what it did afterwards. But one can take that as a very recent and relevant indication of value, I think, when one looks at the potential for this asset.
Does management still think they're worth a lot more than that?
Well, I think if you ask them, their mind is probably in the double-digit plus in terms of where they think they're worth, and it really comes down to what assumptions you use and how conservative you want to be.
Mm-hmm.
It's like AUA growth through the cycle. You want to put a multiple on it, as we were discussing. Is this a higher quality market infrastructure asset? Do you want to be more value and be more higher discount rate on it? What you can see is that on very unheroic assumptions and sell side analysts trying to get to back solve to the current share price, essentially, they can't go much lower than 8. I think the lowest analyst is actually on. I can check that for you. But I think you'd be hard pressed to see anyone pricing this lower than €7 per share, and that's on quite draconian assumptions, right? Where they're trying to back solve for it.
Well, the way I see it, based on our conversation, and I'm just doing some back of the envelope here, I'm thinking, okay, so your free cash flow 240 with a little growth 300. So
Double digit
if we say,
is okay growth. I wouldn't say little growth.
yeah. You're right. You're right. It's better than okay. Right? It's
Yeah.
much better than
Yeah.
okay. But let's say they get to 300 and
Hmm.
the market sees this as a quality company, and we say, okay, it should have a free cash flow yield of like 5% on EV, right?
Hmm.
So that implies like a 6 billion EV, 300 million debt gets to like about €9.30.
Yeah.
So just on that. And let's say, it doesn't get there and it just is 240, same 5% because it's viewed as good quality, then you're still 740. So it's still like €2 higher than where it is now.
Hmm.
So, at what is it, 550 now?
Yeah.
So,
So you're
you
looking
know,
at 50 to 100% upside. Yeah,
so yeah.
on those numbers.
So you just get the sentiment to go in its favor and it's 30-40%, and then you get some positive, um it goes even further, or if you
Yeah.
have a buyer.
And
um
and for anyone looking into this, what will also be helpful to know is that there's this PE overhang element to it. So because private equity, so because Hellman and Friedman did their last placement at €7 per share in November 22, that's definitely weighed on the shares since then. So whenever it approaches €7, there's that element of, well, will they be selling down the whole stake, and do I want to get in front of that train, essentially, right? As a new buyer coming in with fresh money here. And so that was definitely something in mind when this was trading closer to 7. So for anyone looking into this, I would encourage them to make up their views as to do they want to take that risk. But
mhm,
that's
mhm,
not
mhm.
that's not where we are today. Where we're today at the levels that we're in today, it's kind of the fundamentals were taken second. It was more of a special sits story that people were looking out for that announcement. End of last year, they mandated Goldman, reportedly, allegedly in the press, Goldman and Citi to look into options, and then that got called off beginning of this year, and that's where the shares took a nosedive, and they've just kept delivering quarter after quarter. The business keeps getting better, investor sentiment keeps getting better, flows, momentum keeps improving, but people are just waiting for that special situation, take private potential, or is this going to be a placement element, which for people with long duration, longer term horizon, for investing and being patient, it makes it quite an interesting gap.
Is there an overhang from any of the large holders or of any of the companies which have been acquired using shares of selling on any rally?
There's definitely for Hellman and Friedman, yeah, and then BNP, which is the second shareholder at 12%, which came through the acquisition that we discussed in 21. That cross shareholding, they are definitely seen as. I mean, they will openly say that they are actively looking to sell, and hence why that has weighted on the shares at certain price levels, not at these price levels because they're not sellers at this price for sure. They see too much value, but at higher price levels, yeah, like people need to be mindful of that. There's that risk. The
And they
beauty of it
probably
is, like if you have again like enough of time horizon, that this gets solved on a 3 to 18 month type of time horizon, right? Like the
mhm.
transaction that, for people that look into it, the February 23 transaction with Euronext, that was clearly an attempt, like a bilateral attempt by the large private equity, by Hellman and Friedman, type of conversation where they were trying to construct where what that didn't work for them to exit, but we can all just assume that there are conversations ongoing, and people actively looking to exit this business at prices higher than we're seeing today on the screen.
And so they're hoping for any improvement in operations. And unless this unless the market clears, then it'd be hard to really get like the substantial upside. So that it could take a couple of years.
I think a couple of years is a little bit
Too long.
far
Yeah.
fetched. I think it's
Yeah,
too low. I
far-fetched.
think it's more
Yeah.
of a, this was definitely a 23. They wanted to be out. The Euronext transaction was definitely orchestrated. Because if, the people that go through it, like they would see that it fell through very quickly. So that was clearly the anchor shareholder saying, no, this doesn't work. This price doesn't work for us, 875. And the way that it was structured as well, because it was part cash, part shares. So maybe they weren't as excited about the idea of continuing, like part owning the combined business. So there's definitely an element of they were looking to exit in 2023, where at the end, or getting to the end of 24, they're not out. There must be an element of time pressure to an extent for them to get out of this business, but not at the share price. I mean, we've discussed with them, and for the purposes of building our stake, and they're definitely not enticed at this price to do any placements. That's for sure. That's plain for everyone to see that they haven't communicated anything. As I mentioned, at prices closer to 7.2 euro per share, which is where they did the placement, I think that's when the question mark begins of, well, 7.2 and above, will there be that dip of them placing something?
Okay. Okay. And just one last question: the CEO. How big is his position?
It's so reportedly it's not that big when you look at it in Bloomberg and whatnot. It's only like $1 million or so dollars. But the thing is, a lot of it is rolled up in the, and there's some mention to this in the annual report. A lot of it is rolled up in the private equity ownership, like in the
Okay.
30%. So a lot of his economics come linked to that, Hellman and Friedman stake, and for that, whatever part it is of that stake, it's in the tens of millions of dollars as we understand it. So it's life-changing money. He's well incented.
Okay.
He wants to see the share price back at the IPO levels of 12, 13, 14 euros.
Well, he also got a big bonus. Didn't he, when this went public? I think he got somewhere in the prospectus something like 4 million or something.
Yeah. I mean, he definitely, but he's still very much invested in, all of the management team have these, like the top management team have this structure within the Hellman and Friedman stake, like the LCH, if you look at it in Bloomberg, LCH line that you see. And none of them have, for whatever's worth, for people looking into this, none of them have ever sold any stake in any of the placements that happened since 2021. None of them have ever sold one share of their structure internally. They've all kept it until today, which of course has very much hit their pockets, and of course keeps them very well incentivized and aligned with us to put the share price where we think it should be.
Okay. Okay, great. That's fantastic. Any final remarks you'd like to make?
Yeah, well, thank you for having me. It was great. It was a lot of fun, and as I said, happy to. I know that a lot of smart, thoughtful individuals, investors follow you, and whoever has any views, be it positive or particularly negative on Allfunds.
How do they reach out to you?
I'm on LinkedIn, easy to find,
Okay.
and by all means, anyone can reach out.
They can just ask me, and I can connect you guys as well.
Absolutely, yeah, that too.
But Julio, thank you very much for your time. Apologies for any confusing questions or of me trying to understand, but I'm sure anyone else who hasn't spent as much time as you is probably trying to understand what's going on here. Thank you, and I guess I will see you in February then in clusters.
They were all good questions. Thank you, Sophocles. I look forward to
all right.
them.
Thank you. Have a good day.
Ciao. You too.
Bye. The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.